All right, in Chapter 10, we're going to be talking about bond financing and also other types of long-term liabilities. This may be some of the harder material for students to understand. When a company or an organization needs a large amount of money for an expansion or to get their business off the ground, they may issue bonds to bring in that money. And the other way to do financing is to sell stock. But when you sell stock in a company, then those people become owners and then therefore have decision-making capabilities in the company. Whereas if you sell somebody a bond, your only obligation to them is to pay the bond back at the maturity date, but also to pay interest during the course of the time that the bond has been issued. So that's one of the advantages of using bond financing, is because that person that buys your bonds, or those people who buy your bonds, do not have any kind of ownership control. When you issue a bond, there's a par value or a face amount. So generally speaking, bonds are issued in $1,000 face value or $5,000. And then there is a contract rate in terms of the amount of interest that's going to be paid during the time that that bond is outstanding. The advantages of bonds are listed here. As I've already mentioned, they do not affect owner control, meaning that when the person owns that bond, they have no ownership rights. They can't make any decisions about the company. So for the company, that's a good thing because these people can't interfere in their decision making. Second thing about bonds is that the interest that you pay on those bonds is tax deductible. So every penny that you have to pay out in interest is a tax deductible expense and comes off of your net income, so you pay less on taxes. And then the third thing is that bonds can actually increase your return on equity. Now, equity is the amount of stock that you've sold, the amount that your stockholders own within the company. And by issuing bonds, you can actually increase your return on equity. This is called financial leverage or trading on the equity. Now, let's talk about how that works. They give you an example of a particular company that currently has $1 million in equity, meaning $1 million in stock, and they're wanting to expand, and they figure this expansion is going to cost them $500,000. But by doing that expansion, it'll yield them $125,000 more in income every year. So in order to determine whether or not you want to use bond financing, meaning issuing bonds and then paying interest on those bonds, or equity financing, meaning selling stock, which creates more ownership in your company. But again, those people would then have decision-making powers within your company. Or just don't expand at all. Is it better just to stay where you are? So those are your three choices. And the chart here in the book shows you what would happen in each of those circumstances. So under Plan A, you could just not expand at all, so your income would stay at the $100,000 that you're currently making. There would be no interest expense, so your net income would be $100,000. Remember, we said that there's $1 million in equity, $1 million in stock in the company right now. So if you take $100,000 divided by $1 million, you get return on equity of 10%. Now, if we decided to expand, but we did it by selling more stock, equity financing, our income, based on what they explained up here, our income would go up $125,000. So we now would have net income of $225,000. But now we have equity in the company of $1.5 million as opposed to just $1 million. So if you divide the net income by the equity, you get 15% as your return on equity. So obviously that's better than not expanding. So you probably would want to do that. However, the third option is to do the expansion by selling bonds. Now when you sell bonds, you're going to have interest expense every year. So even though your income goes up to $225,000 like it does here, you have to deduct your interest expense to get your net income. So your net income is now only $175,000, which doesn't necessarily sound good. But remember, your equity is still at $1 million, not $1.5 million, because you didn't do the expansion by selling more stock. So when you take your net income and divide it by your equity, your return on equity is actually 17.5%. So it's actually better than your return on equity under the equity financing plan. So for those people who own stock in this company, their return is better if they go this route as opposed to selling more stock in the company, which only yields a 15% return. Now, there's disadvantages to bond financing as well. Bonds can decrease return on equity. What if you actually ended up having a bad year and you did this expansion but you earned less money? If you earn less money than you did the year before, then this actually can decrease your return on equity. So this figure could actually be lower than this figure or even this figure. The second thing is issuing bonds means you have to make these interest payments. Interest payments are usually made twice a year. So if you were in a cash flow situation where you didn't have a lot of money coming in, that may actually cause problems because you wouldn't be able to keep up with these interest payments. So these are two issues that could happen, but in most cases a company wouldn't take on bond financing if they didn't feel like they could make those interest payments. So here's a couple of points that are important here. Debt financing, meaning selling the bonds, is desirable when interest is tax deductible, when owner control is preferred, meaning you don't want to give up any more ownership control, and when return on equity exceeds the debt's interest rate. The phrase debt is cheaper than equity refers in part to what we were talking about here. In this case, debt would be cheaper than equity because your return on equity is actually going to be better under bond financing than it is under equity financing. Now, bonds themselves are traded, kind of like stocks are. They're securities, and they can be bought and sold, and a lot of times you can do that on the New York Stock Exchange or the American Exchange. As I said before, these can be sold in denominations usually of $1,000 or $5,000. And obviously you're not selling all these bonds to the same person. I mean, they're sold to many different people. And then even after they're sold the first time, they can be resold. So a particular bond could be held by many different people before it ever comes to maturity. Another thing about bonds is that they don't just sell at their face value or their par value. They can be bought and sold at discounts or premiums. And so when you're buying a bond, it will show something like this. It might say it's trading at 103.5, which means that you can buy or sell that bond at 103.5% of its face value. So a $1,000 bond would cost you more than $1,000 because it's selling at 103.5%. The same thing with selling at a discount. When a bond sells at a discount, it's going to say something like 95, 96, 97, and that means it's 95% of its face value. So a $1,000 bond in this case would sell for $950. And then there's various procedures for how you go about issuing a bond. I can let you read this on your own that explains kind of more the legal language of a bond. But generally speaking, the bond will have the face value on it, and it will also have the rate of interest that's going to be paid on that bond during its life. Those are the two important things, the face value and then the contract rate in terms of the interest that's going to be paid. All right, when a bond is first issued, now we're going to talk about what we have to do from an accounting standpoint if we are dealing in bonds. So when a bond is first issued, if it's being issued at par or at face value, it's easy to record. So let's take this example. Suppose company receives authorization to issue $800,000 of 9% 20-year bonds dated January 1st, 2013. And they don't mature, if it's a 20-year bond, obviously, until December 31st, 2032. They're going to pay interest semi-annually on June 30th and December 31st. So the interest gets paid twice a year. And when you issue these bonds, you're going to sell the bonds and get cash for them. So the way you would record this is how much cash do you get? Well, you're selling them at face value. So you get $800,000 in cash. And you owe this. Now it's a debt to you. You have a liability. So it goes into the bonds payable account for $800,000. Now, the next entry that you're going to have to make is on June 30th when you pay the interest. The interest is going to be $800,000 times 9%, which is what's listed here, but it's only for half a year. So you take that number and divide it in half. So your interest expense would be bond interest expense. You debit the the expense account for $36,000, and then you have to pay this out. So you're going to credit cash for $36,000. Now, when this comes due, you're going to make this entry every 6 months. But when these come due in the year 2032, the entry would be to debit the payable account, to take it off your books, and then to credit cash, because you're going to have to pay out the $800,000 in cash at that point in time. So it's pretty simple if things are issued just at face value, but that's, to be honest, kind of the rare situation. So we're going to talk about bonds that are issued at a discount or at a premium. Now, as we said before, there is a contract rate in terms of the amount of interest that a bond issuer has to pay on these bonds. And so the interest is calculated by taking that interest rate and multiplying it by the face value of the bond. So in this example, if a company issues a $1,000 8% bond paying interest semi-annually, you're going to take 8% times 1,000, which is $80, and then you're going to make 2 semi-annual payments of $40 each. So that contract rate sets the amount of interest that the person issuing the bond, the company issuing the bond, has to pay in cash. However, that is not necessarily the actual bond interest expense, because that interest expense depends on the market value of the bond. Remember, we said that when these bonds are first issued, they're issued at face value, but over time, their value can change based on the market rate. So the market rate is the interest that borrowers are willing to pay or that lenders are willing to accept for a particular bond and its risk level. So market rate and contract rate are often not the same. So when the contract rate and the market rate are equal, a bond will just sell at its face value. But when they're not equal, the bond will sell at either above face value or below face value. If the bond sells above face value, it's selling at a premium. And if it sells below face value, it's selling at a discount. This chart's important to understand. You have your contract rate, the interest rate that's actually printed on the bond, but then you have your market rate. And this is what will tell you if the bond is going to sell at a premium or a discount. If the contract rate is higher than the market rate, the bond will sell at a premium, meaning 101, 102, 103, something like that. Obviously, if they're equal, it just sells at its face value. But if the contract rate, what's printed on the bond, is less than the market rate at that time, the bond will sell at a discount. So it'll sell at something below 100. So let's look at what happens if you issue a bond at a discount. So a discount on bonds payable occurs when a company issues bonds with a contract rate less than the market rate. This means that the issue price is less than par value. Alright, so they give you an example here of a company that is issuing bonds with a $100,000 par value, an 8% contract rate, and just a 2-year life. But if the market rate is actually 10%, then the contract rate is less than the market rate. So contract rate is less than market rate, so it's going to sell at a discount. And in this situation, the discount it's at 96.454%. Now, the person issuing these bonds is still going to have to pay back $100,000 at the end of the 2-year life. So they're going to have to pay the full $100,000. But in the 2-year period, they're going to have to make cash payments of $4,000 every 6 months, because it's 8% and then 8% for the year, so that would be 4% for half the year. Now, when they get the money, they've issued these bonds, they're not going to get $100,000, they're selling at a discount. So they're only going to get $96,454. But the amount that they're going to have to pay back in 2 years is $100,000. So the bonds payable amount is $100,000. The amount of cash they get is only the $96,454. So the difference between those two numbers has to be put into an account called discount on bonds payable. So this amount, $3,546, goes into the discount on bonds payable account. Now, you're going to put these in a section on your balance sheet for long-term liabilities. Now, in the last chapter, we talked about current liabilities, but this is long-term liabilities because it's longer than a year, and it goes in a separate section on your balance sheet. And it would be listed like this. You start with your bonds payable, the $100,000, because that's what you actually are going to have to pay back in 2 years. But then you have to put under that less discount on bonds payable for the $3,546. So this shows you your actual book value of those bonds after the discount has been taken out. Now, this amount right here has to be amortized over the life of the bond, because this is not all an expense when you first sell these bonds. So it has to be amortized over the period of time that the bonds are actually in place. So this $3,546 discount has to be divided over that 2-year period. Alright, this section in your book to me is a little bit confusing, the way that they're wording it, but basically you're going to have a total of $16,000 in interest on this bond, because remember, it's a 2-year bond and it's 8% a year. So each year would be $8,000, so 2 years would be $16,000. And then that's going to be paid out twice a year, so it's going to be $4,000 every 6 months for the 2 years. So you've got $16,000 in interest expense. But this is also an expense. The discount on the bond is also an expense of $3,546, and you want to divide that also over the 2 years. And just as you pay the interest every 6 months, you're going to divide this into 4 different periods and spread it out over the 2 years. So what they explain here is the total then is going to be, in terms of interest or bond interest expense, is going to be $19,546. That's the $16,000 in interest plus the $3,546 in discount. So that amount has to be posted over the 2 years. And they're going to explain here that you're going to do that using the straight line bond amortization method, which basically just says take the $19,546 divided by 4. It gives you a bond interest expense of $4,887 per period. $4,000 of that is the interest. $887 is 1/4 of the $3,546 discount that has to be amortized over the 2-year period. So anyway, they explain it down here, a little confusing I think, but this is the way that you would post it then. Bond interest expense is $4,887 in total. Discount on bonds payable is credited. So what you're trying to do is take this $3,546 and reduce it down to 0 over a 2-year period by, up here, we did discount on bonds payable, $3,546. We're going to get that reduced back down to 0 by the end of the 2-year period by doing it this way. So the total interest expense for the period is $4,887, but $887 of that is the discount, and then cash is credited because you're actually paying out $4,000 in cash. You're not paying out $4,887. So this would be the entry every 6 months that amortizes the discount but also records the interest expense. And this shows you that at the beginning of issuing the bonds, the unamortized discount is $3,546, but every time you do that $887 entry, it goes down to where at the end when the bonds come due, there's no more unamortized discount. The carrying value is $100,000, which is correct because when you actually have to pay for those bonds, then you're going to be paying $100,000. You're not going to be paying the $96,000 something that was listed up above, which is what they explain here. So read through this section because I know it's confusing if you've never done this before. Hopefully the way I explained it makes a little bit of sense, but read through it a couple times and make sure that you understand what you're doing there, because when we get to this next section about issuing bonds at a premium, it's going to be the exact same thing but just in reverse, because these are going to be bonds that are going to sell higher than their face value. And you're going to do pretty much the exact same entries but just in reverse, in the sense that you're amortizing the premium as opposed to the discount. So they give you an example here of some bonds that sell at a premium. So in this case it's 103.546. So you sell $100,000 worth of bonds. Pretty much the same entry as what we just talked about. The amount of cash you bring in though is more than the face value. So you're only going to owe $100,000 at the end of the, is it still 2 years here? I'm going to assume it is. Yes, 2 years. And so the rest of it, the difference, the $3,546, goes into premium on bonds payable. Same thing here in terms of listing it under long-term liabilities. But now you have to amortize that $3,546. Again, pretty much the same way that we just did with the discount, but in this case, the bond interest expense is going to be $5,113, premium on bonds payable $887, cash is $6,000. In this case, what's the interest? 6%. So you've got $6,000 a year. So it's going to be a total of $12,000 over 2 years, plus the amount of the premium, which is $3,546. So you're going to have a total of 4 interest payments of $6,000, $24,000. The total bond interest expense is going to be $20,454. Now see here, obviously, because you got more money up front, you're actually reducing the amount of interest. So your total expense is only going to be $20,454, which is less than the $24,000 total interest because you actually got more money up front. So the amount that has to be journalized every 6 months is going to be $5,113. So the bond interest expense is $5,113. You're going to amortize the premium on bonds payable at $887, and the amount of cash that you're going to pay out is $6,000 each period. So when you sell at a premium, it actually decreases your bond interest expense, whereas a discount on bonds increases your bond interest expense. So as we said before, you're actually paying out $6,000 in cash, but the amount of interest expense is only considered $5,113 because the rest of it is going into your premium on bonds payable. Again, read through this. If it doesn't make sense to you logically at this point, then just memorize the entries, because it's one of those things that the more you do, the more it'll make sense. But sometimes in the beginning it seems confusing. So look through these two examples, how to do it for a discount, how to do it for a premium, kind of memorize how to go about doing that. And as I said, the more often that you do it, it will start to make more sense to you. Alright, one of the things that you're going to have to do in your homework and on your quiz is to figure out how to come up with the price of a bond. You know, if you're selling a bond on the exchange, you can look this up in the newspaper and it just tells you the price of the bond. But not all bonds are sold on, like, the New York Stock Exchange. So there is a way that you can actually calculate how much that bond is going to cost you. Meaning, is it going to be face value? Is it going to be sold at a discount? Or is it going to be sold at a premium? In order to do that, you have to use present value concepts. And this is covered in Appendix B at the end of your book. But let's talk about how to do one for a discount bond. In this paragraph, it explains that the issue price of bonds is found by computing the present value of the bond's cash payments discounted at the bond's market rate. I know that probably sounds confusing, but it's actually easier to figure out than you might think. So when we're computing the present value of, in this case, the FILA bonds, which were talked about above, we talked about the fact that the interest is going to be paid semi-annually, and the market rate is 10%. So that's 10% a year, so the semi-annual rate is going to be 5%. So in for a 2-year bond, you're going to have 4 semi-annual periods. So in order to calculate the price of this bond, what we have to do is take that information and find the present value of the $100,000 par value paid at maturity. Meaning, you know in 2 years you're going to have to pay back $100,000. But that's not what you're going to be paying right now, or not what you're going to be receiving right now. You're going to get less than $100,000 when you sell these bonds because it's being sold at a discount. So what exactly are you going to get? Well, if you go to the present value table that's found at B1 in your appendix, you would take, let's see here. So you would go to row 4, because that's the amount of interest, the 5% interest, and go, sorry, I'm confusing you. If I go to the table, I'm going to lose my place here. But if you follow that table, let's see, now let's just try it. Let's see if we can get to it. All right, so we're talking about 4 periods because it's a 2-year period and 2 semi-annual, so 4 periods, and we go across to the 5%, which would be 0.8227. So this is the value that we're going to use for the $100,000 that we have to pay back in 2 years, because the present value of that $100,000 is less than what it will be in 2 years. So this is the figure that you're going to use for that piece of the equation. Let me go back to chapter 10. I apologize for the confusion, but so that's how you would get one part of what you need for this to figure out the bond pricing. So they said you're going to need 2 things. You're going to need the present value of the $100,000 par value paid at maturity, but you also need the present value of the series of 4 semi-annual interest payments of $4,000 each. So you have to get these 2 pieces of information. You do the first by going to table B1, because that's the present value of a single amount, and then B3 gives you the present value of a series of payments. That's why the charts are different. This one is just one amount, $100,000, and that table is B1. But to get the present value of a series of payments, you have to go to table B3. It's going to be a different present value factor. So I showed you how to come up with this number here. You would do the same thing by going to B3 and doing the same thing as far as 4 periods and the interest rate. So this gives you this factor. So then you would multiply the $100,000 that's due at maturity times this factor. That gives you a present value. So that bond is worth $82,270 right now. The $4,000 interest payments over 4 years would be equal to $14,184. And when you add those 2 together, that's how you get the price of the bond of $96,454, which we had shown up here when we were looking at the FILA bonds. We were talking about that this bond was going to cost $96,454. That's how they came up with that amount. You take the present value of the $100,000 and the present value of the amount of interest that's going to be paid to calculate what that bond pricing should be. Okay, so that's what they did here using table B1 and B3. Now, if we go to a premium, we do the exact same thing, except in this case, it's being sold at a premium. So you have the $100,000 par value. If you notice, that is the same because the par value of the $100,000 isn't going to change. But what's different here is that the interest payments, again, the same present value factor, because you're looking at the same place on the chart, but because now the interest payments are $6,000, you're going to have a greater amount of present value for the interest, and that's why the bond is going to sell at a premium. So this is how you actually calculate the price of the bond. I mean, if you're just buying something off the New York Stock Exchange, it's just going to be posted there for you. But this is how those numbers are actually calculated. And you're going to be asked to do this on your homework and on the quiz. So be sure that you know how to look these numbers up, these factors up on the present value factor tables so that you can do the homework. It's not difficult as long as you find the correct present value factor and multiply it by the correct amounts. So again, read through this on your own. And if you do this quick check, I think this might help you as well in terms of understanding how to do the pricing for these bonds. All right, up to this point we've been talking about bonds that are held until maturity, but that's not often the case. And so when a company wants to retire bonds, if they do just retire them at maturity, meaning that the time comes when they're due, the 2 years, the 5 years, whatever it is, then the way that you record that is you just debit bonds payable to take your liability off the books, and then credit cash because you're paying out the cash to buy those bonds back. But if you retire them before maturity, if you don't wait the full 10 years or whatever it is, then the entry is going to be different, and it's possible that you'll either make money or lose money by doing that. One example given here is that issuers will sometimes want to retire those bonds because maybe interest rates have gone down a lot and they can replace their high interest bonds with low interest bonds. And so they would call in those bonds, exercise a call option, or actually go out and purchase bonds on the open market to get them back and be able to reissue bonds at a lower interest rate. So if an issuer decides to call those bonds, this is called a callable bond. And this type of bond gives the issuer the option to call the bonds before they mature by paying the par value plus a call premium to bondholders. In the second case, you're just buying them on the open market, so you're just purchasing the bonds back at their current price. They give an example here is if you're retiring callable bonds, par value $100,000. If the call option required the issuer to pay a call premium of $3,000 in addition to that, then assume that after June 30th, 2013, interest payments, the bonds have a carrying value of $104,500. So the bonds are actually on their books at $104,500, but they're able to call them in and only pay $103,000 for them because that's the market rate at that particular point in time. So the bonds themselves have a $100,000 par value. The premium on the bonds payable that are still on the books is $4,500, but they've been able to buy them back at just $103,000. So that's what it's going to cost them in cash. So the difference between these would be a gain that they have made by being able to purchase them back early. And so you put that into an account called gain on bond retirement. Now, if this were reversed and they actually lost money here, then it would go into loss on bond retirement. But this is how you would record it if you called those bonds in early. Another way to retire bonds is to convert them to stock. And when you do that, you retire the bonds, $100,000, and then you place the difference into the stock accounts or the equity accounts. Now in this case, what they converted it to was 15,000 shares at $2 par value. So the stock itself is just $30,000, but there's an additional account called paid in capital in excess of par value. It's also an equity account, and it just records the amount that you paid that's higher than the actual face value of the stock. And it's still considered an equity account, but it just keeps it clear as to how much of it is actual par value of stock and how much was paid in excess of that par value. So if you are converting it to stock, giving somebody ownership in the company, then this is how you would record that.